That's going to worry a lot of people that quickly got comfortable with yesterday's auction. What is there to worry about? Why that move back to 5?
So we have to kind of zoom out a little bit and realize that in spite of all the talk around cutting rates and why it makes sense to cutting rates and this administration stomping its feet and demanding lower rates, right? The reality is that we've seen this movie before. The Fed did start to cut rates and did so very aggressively around this time last year, a little bit later, and we saw the long end move up. And the 30-year continues to be stuck around that 5% level. And currently, we have a stock market that's surging. We have crypto at all-time highs. We have a jobs backdrop that's still very constructive at 4.1%. There is really no impetus for the Fed to be any more aggressive here. But even more importantly, and this is where I disagree with the prior speaker and a lot of what's out there currently, it's irrelevant what they do at the front end because they do not control, so if we are talking about lower borrowing costs for small businesses or lower mortgage rates for borrowers who want to buy homes, that is not going to necessarily flow out of a, lower Fed funds rate.
Which raises this issue of if they lower rates on the front end, how much will that actually generate growth and inflation that will cause the long end to go up to that 5-6% rate? I mean, exactly. That's ultimately the question. Why would it then affect the long end so much if it didn't have the stimulative effect in the short term?
So we saw kind of an interesting combination of factors when the Fed started hiking, right? Under any normal, quote unquote, circumstances, that would have been a restrictive environment, with the exception that we had tremendous fiscal loosening that essentially blunted the effect of monetary policy, I think. And we're continuing to see that. Financial conditions are quite constructive, quite loose. Once again, we have the big, beautiful bill contributing to an already, around a $2 trillion deficit, going to go up to about $2.5 trillion, right? So all of these things are inflationary. And from a technical standpoint, there is more and more issuance that the Treasury needs to finance. And that is not a constructive technical backdrop for the long end. So we're talking about, the macro backdrop, which is, tariffs and lower labor supply and immigration policy and kind of defense spending and all these sort of non-discretionary spending components of the budget that are going to continue to move up and contribute to the inflationary backdrop, which, by the way, inflation has completely stalled out. Right, any move down and it has completely stalled out. And in addition to all that macro stuff, we're also talking about the technicals, which are just going to continue to be not constructive for the long end to meaningfully move lower here, irrespective of, how many times this administration stomps its feet.
How do you put this all together in the sense that 10 out of the 19 officials, according to the minutes, think that we're going to get 2 cuts this year? And you think actually what the Fed is doing is correct right now?
Absolutely. Well, this is no different from any other year when we had, 7, 8, 6, 5, you name it, cuts baked in, and then ultimately ended up with a couple, albeit aggressive ones last year. I think this will be no different. We're going to continue to see even the Fed itself, right, when in the last kind of survey, when Fed members were surveyed in terms of where do they think risks are, every one of them said that inflation risks are skewed to the upside. And many said that, the labor picture, the risks there are possibly skewed to the downside. And so far, the labor data has been okay. And by the way, I would argue that as population declines, we may not need the kind of blockbuster, jobs numbers we've seen in the past to continue to have a very constructive labor market.
You said that if yields go back up to that 5% level, and I'm talking about 10-year yields, it will pressure all sorts of other assets. Are you talking about credit at a time when a lot of people have been saying that it's a really constructive outlook, even at these tight spreads?
Particularly below investment grade credit, right? So investment grade credit has 2 things going for it. Number one, fundamentals there are, as constructive as they've been possibly ever. Yes, there's been some perhaps overspend on buybacks, but generally those balance sheets are good. And they also have the benefit of receiving support from the Fed as major employers of Americans, right? These are blue chip companies. And yes, the government and the Fed are going to come to their rescue if that needs to be the case. Below investment grade credit is in a different situation because these are not cash rich flow companies. And I know that generally the pitch there is, well, defaults have been very low. The makeup of the high yield space is now higher quality. Well, let's really dissect that. So the 12-month trailing default yield for high yield is 1.3%, something like that. If you add to that distressed exchanges, that number nearly doubles to around 4.5 to 5%. If you add to that the PIK activity that we've seen, which is pay in kinds, which is essentially, I can't pay you back in cash, so here's more debt, right? Then we get to an even higher level. So in essence, if we were to really take stock of all the activity related to, I don't have the money to pay you back, we're ending up with a 5%-ish type default level, as opposed to the one handle that's being reported.